That's it. We're reaching the final session for the day, and have we got a big one for you? So we're going to be talking about the world's second largest economy and the global superpower on the Asian side of the planet. Of course, we're talking about China. And to give you the outlook for Chinese investments this year, we have Mr. Tommy Xie, the head of Greater China Research and Strategy at OCBC Bank, and Mr. Ong Xun Xiang, ETF Product Specialist from Lion Global Investors. Tommy Xun Xiang, over to you.
Thanks, Ewa. Hi, everybody. I'm pleasure to join here. So I think it has been certainly a very exciting month for China, right? So if you are investing in China, it's basically a roller coaster month, right? So it's certainly a good opportunity for us to talk about China in today's session. So I think for today, what I want to do is I want to cover 4 points here, including number one is the China's growth target and its implications, and then number two is what the investors worry about China, right? Number three, I want to talk about what are the possible solutions from the Chinese government to solve those problems, and then number four is what to watch out for going forwards. Please allow me to share my slides. Wait, just give me a second. Sorry about that. Okay, so do let me know if you have any problem to see the slides. Okay, let me just say, okay. So I think for today, certainly, I mean, uncertainty is the keywords, right? I think not only for the global economy, also for Chinese economy as well. So that's why I think what I want to share is more like the, how to deal with the uncertainty right now we are facing. I mean, first of all, let's talk about the growth target, right? So we know this year, China set its growth target about 5.5%. So, if you look at the median, the message from the media, I mean, basically people talk about this is considered as ambitious, right? But if you look at the past, I mean, 5.5 actually is considered as one of the lowest growth target in Chinese history, except 2020, right? But why we think this 5.5% is ambitious this year for China, I think that could be about two reasons. I mean, the first reason is if you look at this growth target is based on a relatively high base, because last year China grew 8.1%, right? Because we know the GDP sometimes is a mathematics game, right? It's basically how you do the divide, right? If your base is low, of course, your number tend to be higher. If your base is high, your number tend to be lower. So based on this high base, so the 5.5% is not a low number, right? Number two is also, if you look at the IMF forecast, in the beginning of the year, actually IMF downgrade China from 5.6% to 4.8%, citing the concern about the COVID-19 as well as other reasons, right? So it's also quite rare for us to see a kind of, divergence between the IMF view and the Chinese official view. I think those are the reasons contributing to the ambitious growth target for this year. Okay, we talk about the growth target, right? So I think if we did a quick comparison, last year, China said the growth target is above 6%. So last year, the above 6% actually is considered as low because in 2020, China only grew about 2.3%, right? So I think this year, 5.5 is considered as high, right? I think the reason why China has been more cautious in 2021 last year is because China want to do this deleverage in 2021. So if you look at the chart on the left side, you can see in 2021, in contrast to most of the major economy in the world, the Chinese economy, the total leverage ratio declined by about 7.7%. So that's why I think last year is not a fantastic year for China because of the active deleverage push by the Chinese economy, right, by the Chinese government. So, but on the positive note, because of the deleverage push in 2021, they actually created room, for the policy support in 2022. But one of the disappointments from the market actually is about the downgrade of the, fiscal deficit target this year. So they cut the fiscal deficit target from 3.2% to 2.8%. But it's okay, I think. To me, for China, if you look at whether China got the ammunition or not, it's not only about the fiscal deficit target, it's also about the fiscal expenditure growth. In fact, this year, China has saved a lot of ammunition. I mean, for example, last year, if you look at the chart on the left side, you can see there's a very strong positive draw between the fiscal revenue growth and the fiscal expenditure growth. So this positive draw become the carryover firing power for this year, right? And also, if you look at the local government, government special bond issuance, I think for this year, in the beginning of the year, we have roughly about 2.6 trillion, roughly about the spending, which can be used for the fiscal expenditure spending. So there's a lot of money right now, which can be spent to boost fiscal expenditures. That's why if you look at the chart on the right side, you can see the infrastructure investment in the first 2 months has recovered quite substantially, right? So it's already, outperformed the property investment at the current stage. So roll to 5.5%, right? Now we know we have about around 5.5% in mind. So how to achieve this 5.5%, right? So if you look at the past, for the almost past 30 years, you can see the chart here. This is basically the annual growth target versus the actual number. Almost without fail, China will deliver what they promise, right? So every time they give you the target, they will more or less achieve it. So sometimes when we look at the China, right, it's a bit like solving the math problem, right? So you know the answer, how you find the optimal the solution leading to the answer. So for the economists like us, sometimes we are not questioning about answer, we are questioning about the solutions, right? But so for this year, in my opinion, the ideal path for China to achieve the 5.5%, around 5.5% is basically for the first half, we should see a very strong recovery of the infrastructure investment, then followed by the stabilization of the property market around the middle of the year, then followed by the pickup of the private consumption in the second half of the year. That's, to me, is the ideal recovery path for China to achieve around 5.5%. Again, there's a lot of moving parts at the moment, which will require the policy support from the Chinese government, right? So if you can recall, in the beginning of 2022, there were a lot of the positive sentiment around China because, as I mentioned, China has saved a lot of the policy ammunitions last year, right? So China is the only few major economy still with the room for the conventional policy. They're the only one can still cutting the interest rate, right? Where the rest have to hike the interest rate, right? And also China has already pushed for the deleverage, as I mentioned. That's why initially in the beginning of the year, there's a lot of positive sentiment, but unfortunately, the market did not do very well year to date, right? Due to a number of the concerns. So let me just share with you what are the concerns right now. What are the worries from the investors, right? I mean, the first confusion right now is, of course, about the easing policies. What kind of the easing policy China want to do? Because in China, we have something called a two-tier monetary system, right? You got the money, you got the credit, right? But the money may not necessarily mean the credit. So that's the confusing part, especially for a lot of foreign investors, right? You can do the easing money, but your easing money doesn't necessarily mean the easing credit, vice versa, right? So you got different combinations. So I think for my case, for my opinion, for this year, I do believe China will go down the path of the both easing money and easing credit. But yet, market is still not convinced yet, right? Because market is still waiting for the concrete measures from the PBOC, which we are still not really receiving. So that's why we need to monitor closely on that, right? But the other question is, will China want to ease its financial condition via the easing of FX, meaning like renminbi depreciation? So I don't think so. I don't think China will actively pursue to easing the financial condition by the renminbi depreciation. I don't think that's the case, right? So I want to bring your attention on the chart on the right side. So this is a medium to long-term loan to the household sector, right? So it's the first time in the month of the February in the record, actually China's household sector deleveraged in the month of the Feb, right? So this actually also tells you, the demand is still a bit shaky at the moment, which will require more policy support. That's why I do believe there's a room for China to cut the interest rate further, to support the loan demand, which in turn will support the economic growth. Sorry. Okay, the second confusion, of course, about the property market, right? So since the second half of last year, the property market certainly is in the hotspot, but for the wrong reason, right? So I think, to me, from the macro perspective, what I believe is that, if we want to see a meaningful recovery of the Chinese economy, right? So we need to see the stable property market, right? So otherwise, in absence of the stable property market, I do think the 5.5% will be challenging for China. So I do believe, we should expect more policy support from China, but may not be on the national level, but at least on the ground level, on the local level, we might see some kind of the easing policies to be rolled out, to try to support the property market. I do believe that stabilization of the property market is particularly crucial this year for Chinese economy. Okay, the other confusion, of course, about the regulatory tightening, right? So I think since the second half of last year, there was a lot of news about the regulatory tightening, whether in terms of the anti-monopoly or whether in terms of the, under the framework of we call the common prosperity, right? So China is driving the regulatory tightening. So will that be the concern for this year as well? At least so far, I think the concern is still there. But my sense is that I feel like this regulatory tightening may be at the the last leg of the entire campaign. That's my sense. Why? I mean, maybe for two reasons. I mean, the first reason, if you look at the triple burden, right? We call it the triple burden in China. I mean, in Chinese we call it the 三座大山, right? So I mean, basically, what are the burden for the people, right? If you talk about the common prosperity, I think there is three major burdens. Number one is the housing. Number two is the education. Number three is the healthcare. Those are always the key burdens facing by a lot of people, not only in China, I mean, globally, even in Singapore, right? We are facing the similar burdens. So what China want to do, if you want to pursue the target of the common prosperity, you want to solve the burden for the normal people, right? So seems like they have been more or less touched all the three burdens, right? Last year, like housing and education, we know last year is a bad year for the education. So this year seems like there have been a lot touched on the healthcare as well. So looks like from the triple burden perspective, I think they are more or less touched most of the key areas already. I mean, that's the first reason. The second reason is if you look at the history, regulatory crackdown in China's history is not something so new, right? In the past 15 years, I would say every 3 years, we got one round of the tightening, right? The reason why China want to do the regulatory tightening is because they want to curb something we call the barbaric growth in certain sectors, right? If you can recall, in 2008, we got the dairy. In 2012, we got the high-end catering because of the anti-corruption. In 2015, we got the shadow banking, P2P. 2018 is the gaming. 2021 was the tech, right? So you look at the past, I would say, usually after 12 months of this tightening, things will start to cool down. Right? That's what the history tells us, right? So that I think for this time, maybe we are going to see the similar story as well. So last week, we got this very important meeting, right? If you trade Chinese market actively for the past 2 weeks, it's a super roller coaster week, right? So one of the reasons is also because of this meeting, right? I think it's a very important meeting chaired by Vice Premier Liu He, right? So I think why I would say this is important because Liu He tried to address the 5 main pain points in the market right now, which is, to me, is important, right? What are the 5 main pain points, which I mentioned here? Number one is the monetary policy. Just now we talked about the confusion about that. So he did mention that, the monetary policy should take the initiative to deal with the uncertainty. But so far, we haven't seen any concrete measures. We are waiting for that. Number two, he's talking about the, property market risk. He tried to diffuse the property market risk, which I think is important, right? Number three, he's talking about this ADR issues because of the concern about the delisting. He basically mentioned, the China and the US side, they are working together, right? Try to work on some kind of a coordination plan in terms of this ADR issue. Number four is basically on platform economy, right? So he talked about this, we should try to complete swiftly through the standard, transparent, and the more predictable manner. Number five is talk about Hong Kong, right? He tried to, basically to ensure the stability of the Hong Kong market. I think those 5 main points are very important and what are the key pain points right now faced by the market. But what I want to highlight here is, although, this is the government solution, right? To try to solve the pain points, right? But there's two pain points actually is beyond Liu He's reach, which is not easy to be solved in the near term, right? So what are the 2 main points? Number one is the COVID-19 strategy, right? Because China is so far is the only fuel economy right now, is still using something we call the dynamic zero COVID policies, right? So I think certainly there's a lot of positive development right now. For example, for the past 2 weeks, we start to see China fine-tune the standards, right? For example, in terms of how they define the COVID negative, right? So they are using the international standard right now. In the past, if you were in China, if you got caught COVID, it would take a long time for it to be the COVID negative because the threshold level they define is much, much higher, right? As compared to the people in Singapore and other countries. So otherwise, I mean, in simple words, it takes much longer time for it to clear the COVID so-called positive, right? So this become very disruptive in terms of the impact on the people's living standards as well as the economic activities. So we do seeing China try to balance between the disruption to the economy as well as the COVID control. So in Shanghai, we do see a lot of interesting trial, right? But unfortunately, what Shanghai tried to do is Shanghai tried to do something we call the targeted lockdown, right? So far Shanghai still didn't go through something we call the the citywide lockdown. So it's like a targeted lockdown, but unfortunately, it didn't work very well. So I think recently the number of cases keep going up, right? So this could be kind of a setback for China as well, because initially I think China maybe want to use the Shanghai as a test bed to try the different strategy, but I think that didn't work very well. So I think that may potentially delay China's move away from the zero COVID strategy. So that may potentially cause uncertainty in the medium term, right? I mean, that's the first pain points, which cannot really be addressed by Liu He at the moment, right? The second pain points also, beyond China's reach is of course the Ukraine crisis, right? So as we know, the Ukraine crisis is kind of the double-edged sword for China, right? I mean, on one hand, you can talk about, China may potentially benefit from those kind of the diversification flow. I mean, indeed, if you look at the Russians' position, right? Ever since 2017, Russia has diversified their FX reserve to renminbi assets and to China as well, right? So right now, 13.1% FX reserve in Russia is denominated in renminbi assets, right? About 13.8% actually was placed in China, right? So this is something, not a bad thing for China, but however, given the global tension is getting worse, right? So this kind of the cost is getting higher for China to be working closer with Russia as well. That's why I would say it's kind of double-edged sword. So for China, they need to be very careful, right? It's kind of the very tight rope right now for China, because as you can see, the economic war against Russia by the West is kind of unprecedented, right? So no economic model can really capture the impact of this economic war at the current stage. So we are seeing the war not against Russia, not only on the national level, even on the individual level. So we have something we call the cancel culture, right? So you can see the company withdraw from Russia, individual people try to, distance themselves from Russia. So this kind of the impact, economic impact is really huge, right? So this is also the kind of the wake-up call for China as well, right? So there's a lot of concern, I think, recently in the past 1 to 2 weeks, people are asking, what if, China received a similar level of the sanctions, right? So what's the impact, right? So I think those are the concerns right now from a lot of foreign investors. That's why I think before the Liu He's meeting, actually, we do see quite a massive outflows by the foreign investors, right? But to me, I think the bottom line is that, there's a lot of concern at the moment, but bottom line is that as long as China still sticks to its neutral position on the Ukraine war, I think this damage from the closer tie to Russia should be still within the control, right? That's my bottom line at the moment, because in the end, China is different from Russia, right? The way how Chinese economy integrates to the global economy is much, much deeper, right? As compared to Russia. So I think it's much more difficult for the global economy to disengage with China as compared to disengage with Russia. So let me ending with these slides before I pass to my colleague. Okay, so this is just tell you how deep integration it is between the China and the world. So right now, let me share with you a few numbers. Right now, the global investors roughly have about more than $7 trillion assets in China alone, right? 7 trillion, more than 7 trillion. So for this $7 trillion assets, generate about 417 billion return last year, right? So that's equivalent to about 6% return, which is very high. I mean, but of course, this investment is beyond your normal like equity investment. So this investment is including everything, right? Including your foreign direct investment, your portfolio investment, including the equity and the bond, and your other investment like your deposits, whatever, right? So it's more than 7 trillion, 400 over billion return, right? For China, right? China has about more than $9 trillion investment assets overseas, right? But that only generate about 250 billion return last year. So the Chinese return is much lower, 2.8%, right? So you can see the chart here from here, it's very clear. China market is one of the real market which can offer very decent, very stable return to the foreign investors. On average, every year, it's around 6%. So that's very good return for a lot of foreign investors. So you can see this is a market very hard to disengage at the moment, right? So that's why, just let me to quickly conclude here. Yes, there's a concern about this spillover effect from the Ukraine crisis, but I do believe as long as China stick to its neutral status and the position, I would say the damage should be still within control. Okay, let me just stop here. Let me pass to my colleague. So if you have more questions, we can discuss during the Q&A. Thank you for your attention. Thank you.
Okay, thank you, Tommy, and so much for your insights, and thank you, Edward, for introduction. Okay, let me share my slides now. Okay, go to slideshow from here. Okay, so good afternoon, everyone. Thank you for joining us today. I'm Xun Xiang from Lion Global Investors, also from LGI, which is also known as LGI, and you can call me the ETF guy. So like many of you out here, I used to wonder how ETFs work. First came across ETFs more than 10 years ago when I wanted to use ETFs for my own portfolio. And I realized that ETFs are like Lego building blocks, which you can use piece by piece to build your own investment portfolio. They are also an extremely useful tool to help investors like you and me gain exposure to proper diversification that used to be exclusive to institutions. So today I'm here to share more about the Lion-OCBC Securities China Leaders ETF that is designed to help investors gain access and tap into the growth opportunities of China, which is the second largest economy and the second largest stock market of the world. So as the slide here suggests, the ETF is anchored on two themes: foundation and innovation. So what do they mean? Traditional blue chip players have formed the foundation of China's growth so far. And we are talking about the banks, the commodity sector, and the bread and butter type of sectors within China. And now these sectors and companies have been turbocharged by new innovation and are rapidly adopting technology to future-proof their business models. Many of these companies are also not just leaders within China, but global leaders as well. So through the Lion-OCBC Securities China Leaders ETF, you can capture the growth potential of these China leaders that are transforming the world. So as we start, let me first address the major question, which many of you would already have your mind right now. So in the past few weeks, we have seen huge volatility in the Hong Kong and China equity markets. In fact, China-Hong Kong equity markets fell sharply for days until China's Vice Premier Liu He issued a strong promise in the Financial Stability and Development Committee, also known as FSDC meeting, for policies to boost financial markets and stimulate economic growth on the 16th of March. This was also a statement that came before the US Federal Reserve approved a 25 bips rate hike on the same actual day. So to put into context, like also what Tommy, my colleague, mentioned earlier, Liu He is China's top economic policy maker and top economic advisor to President Xi Jinping. This is also not the first time that Liu He has tried to calm investor fears following a market sell-off. So in fact, if we look back in 2018, Liu He also gave a similar interview with state media, saying that Beijing valued the stock market. And that helped to calm an equity sell-off back then already. So the FSDC meeting also concluded the need to boost the China economy in 2022, and specifically continuing economic development was designated as a top priority of the Chinese Communist Party. So if you read our Q4 newsletter for China Leaders ETF, you would in fact have noticed that this was already highlighted in China's December 2021 Politburo meeting. So in the past 3 decades, like what Tommy also shared earlier, China has delivered on almost all its economic growth targets. So to achieve its 5.5% economic growth target this year, we expect China to loosen its monetary policy, such as cutting the reserve requirement ratio, also known as RRR, the loan prime rate, be it 1 year or 5 year, short form also known as LPR, and also increasing bank loan quota this year, after this strong pledge by Liu He to support the Chinese economy. So in terms of broader context, RRR, which is the de facto lending rate, was already lowered once by 50 basis points back on 15th of December last year. And the 1 year loan prime rate was already cut once from 3.85% to 3.8% for the first time in 2 years at December 2021, and then further cut to 3.7% in February 2022. Thereafter, the 5 year loan prime rate was also cut to 4.6% in January this year. And furthermore, on the other side, which is on the fiscal policy front, Chinese Premier Li Keqiang also explained that China will increase its fiscal expenditure by transferring untapped profits from state-owned financial institutions. And this will help increase additional government expenditure by almost 2 trillion yuan So given all these, based on domestic consumption alone, it is likely that China can achieve its 5.5% economic growth target. And if we also look at recent history in the past 11 years, we will generally notice that after every bad year, when China's government talks about tightening policies in the Central Economic Work Conference, also known as CEWC, the following year usually will focus on growth-centric policies. For example, back in 2011 here, when China's government talked about stabilizing growth and controlling inflation, in 2012, which was the following year, there will be a renewed focus on growth-centric policies. For example, here would be growth amid stability, and this was accordingly reflected in the MSCI China returns on the same year. Another example would be on 2018, where China's government talked about deleveraging. And on the following year, which we see here, we would then see China's government refocusing to support economic growth. So through all these trends, we would say, we notice and see the Chinese principle of exercising caution and balance. And like what Tommy mentioned earlier, curbing and managing barbaric growth. And in how we see it also, it is also to avoid and minimize overheating the economy. So at this moment and this juncture here, we are witnessing a similar trend, again, where China's government focused on regulatory tightening in 2021 here, but switch gears this year to focus on economic growth. So the general direction of supporting economic growth was already fixed and decided in December last year during the Politburo meeting, and we expect the details and the policies to be gradually rolled out later this year. This also ties in well with Liu He coming out recently on the 16th of March to reassure investors about the Chinese stock market. So on the bigger picture also, 2022 is also an exceptionally important year for China, with President Xi Jinping seeking a record-defying third term as party leader. So positive economic momentum will be crucial in pushing this through. In recent months, we have also seen US inflation reaching a 40-year high and experienced America's focus to tighten economic policies and tackle inflation, for example, with its rate hike on the 16th of March. The US Federal Reserve, in fact, is also expected to implement 6 more rate hikes this year and 4 more rate hikes in 2023 until interest rates reach around 3%. However, China is actually doing the exact, or I would say, contrarian opposite by loosening policies to drive economic growth. So with China's renewed focus on economic stability and policy loosening, the Lion-OCBC Securities China Leaders ETF is well positioned to ride on this new wave by providing exposure to 80 industry leaders across 12 sectors. So now let us talk about why China and why specifically the Lion-OCBC Securities China Leaders ETF. So today, China is the world's second largest economy, and all signs are pointing to the rise of China as the next economic superpower. So in short, China is too big for us to ignore. If you look at the left chart here, as of 2020, the size of China's economy is already at 14.7 trillion, which is currently second behind the US. China's growth has also been resilient, delivering on almost all its economic targets in the past 30 years, and achieving positive growth even during economic crises such as the 2009 global financial crisis and COVID in 2020. And if we even zoom into the history of China's economic growth, on the right chart here, for a country that started with 0.3 trillion GDP in 1985 to a giant with 14.7 trillion GDP in 2020, this is basically growth compounded for 11.7% year on year for 35 years. So since the early 2000s, this gap between China and US has also been significantly narrowing, with the market expecting that China could surpass the US in 2028. And based on just existing growth estimates alone, China's economy is already expected to overtake the US in 2028. And in this scenario, where the yuan appreciates further by 6%, just 6%, from today's exchange rate to 6 yuan per US dollar, we expect we could even see China surpassing the US in 2026, which is 2 years earlier than expected. So this means basically for us, we are around 4 years away from this happening. And not surprisingly, China is also expected to lead the world with the highest GDP growth potential in the next few years. And other than being the world's second largest economy, China is also the world's second largest stock market. And as of the end of 2020, it is only just behind the US, already ahead of Japan. And backed by a growing and resilient economy, there are various catalysts that will drive long-term equities performance for China. So I will highlight the 4 key catalysts. First of which will be the growth of domestic consumption inside China's economy. And as of 2020, China already has a middle class of 344 million. So to put it into perspective, this is double the size of the US middle class and larger than the entire US population. And this number is set to keep growing. And within the next 4 years at around 2026, Chinese middle class is also expected to exceed 500 million, which is 1.6 times of the entire US population. And this is also around the time, if you notice, where China's GDP will surpass the US GDP. So such a booming middle class with rising consumption power will be the anchor of China's economy. And second, in terms of our demographic trends, we're seeing a big shift in China's consumption patterns towards service-oriented consumption. So being a service powerhouse is increasingly crucial to the world's economic growth. So if you look back in history, it took centuries for the world's economies to shift from agriculture to manufacturing. And now we are seeing this radical shift towards services. And this growth in services has transformed the composition of the world's economic production and employment, as well as trading patterns. So as the disposable income of China's middle class grows, service industries such as financial services, healthcare, insurance, and education will all benefit from this. And third, in terms of China's digital economy, it has been growing exponentially. And in fact, the pandemic has no doubt accelerated this move into a digital world. So as seen on the left chart here, we have seen China's economy, digital economy, grown 4 times from 2011 to 2020, basically meaning 17% year-on-year growth compounded for 9 years. And on the right side, you will see the growth statistics of the digital economy participants, such as internet users, online shoppers, and online payment users. And all these have helped China develop and evolve into a digital economy leader today. And if we look into the next few years, China's 14th five-year plan also prioritizes accelerating digital development and building digital China, from creating new advantages in the digital economy to accelerating digital development. And all these will further accelerate industrial digitalization and the deep integration of digital technologies such as the industrial internet, big data, 6G, and AI into traditional industries such as manufacturing. China has also been active in reforming and opening up its capital markets. So as you see here, there have been various initiatives such as the Stock Connect schemes to help attract capital and growth. So all these will help China further grow into a global powerhouse. The capital flows into the Stock Connect schemes will also continue to provide technical support for China's A shares and also the H shares. And also another benefit of investing into China A shares is the diversification benefit, because they have demonstrated low correlation with the global market. So by allocating some of your portfolio to China A shares, you may be able to diversify away some risk. And furthermore, the Chinese renminbi has also been strengthening against the Sing dollar. From around like 5.23 in May 2011, it has risen to around 4.65 in February 2022, representing an appreciation of roughly 12%. So in short, to summarize, we see a great compelling growth story in China, supported by strong economic fundamentals, solid companies, and an excellent beta opportunity. So now let me introduce you to the Lion-OCBC Securities China Leaders ETF, where you can gain easy access to 80 China market giants. And this ETF is a joint collaboration within the OCBC group to help investors like you and me gain access to 80 China market giants. And this ETF gives you access to the 80 largest Chinese companies listed on the Hong Kong Stock Exchange, Shanghai Stock Exchange, and Shenzhen Stock Exchange. There's a full replication of the Huntsing Stock Connect China 80 Index, and each security is capped at 8%, with each sector capped at 40%. So to ensure diversification across different sectors and different stocks. And a very important point to highlight here, this is also the first China-focused ETF that will make a distribution in Singapore. So many Asian investors like you and me actually like dividends. So this the China Leaders ETF will actually be able to fulfill and satisfy this need for dividends. And if we dive even deeper in terms of the selection criteria by Huntsing, the index methodology filtered an initial universe of 1,900 stocks, made up of 1,400 A shares and 500 Hong Kong listed equities to the 80 constituents you see today. So this is roughly around 4.2% of the entire universe. And the eligible stocks must also fulfill geographical criteria, such as 50% of revenue from mainland China, turnover requirements, for example, like 6 months average daily turnover being more than 20 million yuan. And thereafter, these eligible stocks will be ranked by company market value, with the top 80 selected as constituents. The index will also be rebalanced quarterly to ensure you have exposure to the industrial leaders that drive China's growth and expansion. And as mentioned earlier, there's also an 8% securities weightage cap and 40% sector weightage cap to ensure a diversified portfolio of industry leaders. And as we intended for the portfolio to be diversified, there's a combination of old economy and new economy leaders that will both benefit from the catalysts that drive China's growth and expansion. And this portfolio is also inclusive of different constituents listed across Hong Kong Stock Exchange, Shenzhen Stock Exchange, and Shanghai Stock Exchange. So as you see here, as of the end of last month, 64% of the constituents are listed in China, and 36% of them are listed in Hong Kong. So, and since its listing on the 2nd of August 2021, the ETF has closely tracked the Huntsing Stock Connect China 80 Index and enjoyed stable performance despite the overall Chinese market volatility and regulatory reconfiguration. In fact, between the listing date of 2nd of August 2021 and as of the end of last month, 28 Feb 2022, the index has outperformed other reputable peer indexes, for example, such as the Msci China Index, the Msci Emerging Markets Index, and the Shanghai Shenzhen CSI 300 Index. And in the exact same period, the ETF also outperformed other China-focused ETFs listed on the SGX, such as the Xtrackers MSCI China UCITS ETF and Lightsource China Enterprise UCITS ETF. And in fact, if we even compare to the China-focused active funds within the same period, the ETF also outperformed them. So some examples would be the UBS Lux China Opportunity Equity Fund, the Fidelity China Focus Fund, the Aberdeen China Asia Equity Fund, and the Goldman Sachs China Equity Fund Investor Class. So in fact, these active funds have management fees of more than 1.5% per annum, compared to our China Leaders ETF, which has a management fee of roughly only 0.45%, which is just a small fraction of what the active funds already charge. So by being an investor in the China Leaders ETF, you will be paying less for better and more stable performance. And the reason for such resilient performance so far can be attributed to the index exclusion of American Depository Receipts, also known as ADRs. So this helped to reduce exposure to the foreign regulatory risk that placed heavy pressure on US listed companies, such as Alibaba, Baidu, DT, and Neo. And in fact, given the boiling US-China tensions we see here, there have been predictions, in fact, that most Chinese companies listed on the US exchanges may likely delist from the US by 2024. So by providing diversified exposure to 80 industry leaders across 12 sectors, the Lion-OCBC Securities China Leaders ETF is less vulnerable to foreign regulatory risk and better positioned towards stability and resilience. And if we look further at the top 20 constituents, you would have noticed that many of them are household names that are consistently industry leaders. For example, Ping An Insurance, Guizhou Maotai, ICBC, which is the world's largest bank, Tencent, and BYD. Among these constituents, Guizhou Maotai was the favorite drink of China's founding father, whom you all know as Mao Zedong, who served it during state dinners when former US President Nixon visited China back in 1972. And since then, it has been the brand of choice for elites at business banquets and considered a status symbol because of its premium price and limited supply. And globally, it is the world's largest liquor company, which is bigger than Diageo and Constellation brands. It is also larger than Coca-Cola, which has long held the crown as the world's largest beverage maker by market cap. And so being valued at around 2.14 trillion yuan, or around like 340 billion USD, Huizhou Maotai is actually larger than Toyota, larger than Nike, and larger than Disney, and also larger than China's 4th largest bank. So imagine the scale of a liquor company for it to be larger than the world's largest bank. And another constituent, which is Tencent, also just recently reported its Q4 earnings earlier this week. So on an IFRS basis, its operating profit is roughly 17.2 billion USD, showing an increase of 72% year on year, with operating margin also increasing to 76% compared to 48% last year. The profit for Q4 2021 was also at around 15 billion USD, being an increase of 61% year on year, with net margin also increasing to 66% from 44% last year. And in fact, if we look at a fiscal or full year basis, its total revenue in 2021 was around 87 billion USD. So this showed an increase of 16% over 2020, despite a challenging 2021. And on an ESG front, Tencent also announced its commitment to achieve carbon neutrality in its own operations and also its supply chain, and use green power for all of its, in fact, 100% of its electricity consumption by 2030. According to Ma Huateng, who is Tencent's founder, chairman, and CEO, despite the various financial headwinds, it has continued to make strategic progress, including driving widespread adoption of its enterprise software tools, increasing content creation in Tencent's video accounts, and expanding its international games business. So all these will favorably position Tencent for growth when the regulations on the Chinese tech sector begin to gradually relax. And another constituent, which is Anning Deshitai, also known as CATL, is the world's largest EV battery manufacturer, supplying batteries to powerhouses such as Tesla. And a little fun fact, as of last month, which is February 2022, its founder's net worth is already at 48 billion US dollars, overtaking Jack Ma back in July 2021 and overtaking Li Ka-shing back in May 2021. So as you and I speak, we are witnessing a symbolic moment in the clean energy and innovation boom. So to summarize, I want to take this opportunity to emphasize that we are positive on the long-term structural growth story of China. The Lion-OCBC Securities China Leaders ETF instantly offers you diversified exposure to 80 China market giants. And by excluding ADRs, the ETF is less vulnerable to foreign regulatory risk and may be a resilient building block to your portfolio. And with just 2 Sing dollars, you will be able to participate in China's growth story. You can access this ETF by logging onto your broker's portal and searching YYY for the Sing dollar counter and YYR for the renminbi counter. I'm now more than happy to address any burning questions you have. Okay, I see a question on our view on China, view and outlook for Chinese equities. Okay, so I can take this question first, and if there's anything, Tommy can also chip in. So our view from our house view remains positive on Chinese equities in 2022 because of 3 key reasons. First, the Chinese government's focus on economic growth in 2022, as suggested by the use of the keyword stability during the CEWC in December 2021. Second, China is on an easing cycle as compared to other major economies such as the US, Europe, and also Japan. And third, relative valuations of China have been currently, I would say, rather undervalued after the underperformance of the Chinese equities market in 2021. So the base case we see is that China would defend its 5.5% GDP growth target by using tools such as the triple R cuts, interest rate cuts, and increasing loan quotas for banks. So, and they could even move to relaxing the property market regulations and fiscal spending at a later stage with greater positive impact on the stock market. So that said, we will still want to highlight that there may be still some short-term worries that have weighed on the Chinese equity stock market. So the recent sell-off can also be attributed to a few reasons. First, there have been speculations that China could take the side of Russia. The risk of delisting of Chinese ADRs as the US SEC's rules about auditing come into force. And third, the impact of COVID-19 policies as Shenzhen and Shanghai announced targeted lockdowns from increasing COVID cases. And in fact, on the Russia issue, we see that China has been increasingly distancing itself from the Russians with more neutral statements. And given the strong reactions we have seen by the US, the UK, the EU, and Japan, and also even Australia, it is unlikely that China would want to risk secondary sanctions by these different countries. Russia also as a trading partner is much smaller compared to the US or EU. So it is actually irrational for China to choose Russia or to take Russia's side on the Ukraine war. So our base case is that the risk of China assets facing secondary sanctions from a wrong political choice is low. And the US SEC has also released the names of the first batch of companies that did not switch to an approved auditor, according to the Holding Foreign Companies Accountable Act in March this year. The China CSRC has also issued a statement stating that a collaborative arrangement that meets the legal and regulatory requirements of both countries can still be made. So all these positive attitudes we see could provide for some calm for the Chinese ADR stock prices, but the delisting risk, I would say, still remains a bit. And these risks can still weigh on the stock performances of Chinese ADRs. And thirdly, and another perspective, Chinese resolve to maintain its zero COVID policies has been demonstrated by the lockdowns we see in Shenzhen and Shanghai. And Shenzhen and Shanghai are key and important ports and manufacturing hubs. So disruptions to the supply chains could result from the lockdown. And consumption might also slow down with more lockdowns as the cases of COVID spread to other parts of China. But that said, the Chinese government does still have many policy tools to defend its 5.5% economic growth target, though we might still see short-term slowdown and volatility before the Chinese government announces more supporting measures and policies. See a question about what's the stock code for the ETF and what currencies can I trade the ETF in. Okay, so basically for the stock code is YYY for the Sing dollar counter and YYR for the renminbi counter. Okay, then there's the next one about the ETF's distribution yield. So roughly as of this month, we see that the index 12-month trailing indicated dividend yield is roughly at 2.6% with a PE of around 12 as of last week. We see. Okay. Okay, we see there's also a question about the rebalance of the YYY constituents in the near future. In fact, the YYY, the index was recently rebalanced in earlier this month. So there have been addition of some constituents that were added inside the portfolio of the index. Okay, let's see. Okay, there's a question about the the distribution policy. Okay, basically it's annual and the dividend rate will be announced in June this year. Okay, there's a question of whether SRS or CPF can be used. So basically to purchase the ETF units, you can use both cash and SRS, but CPF is currently not an available subscription avenue. Okay. Okay, there's a question about why Alibaba is not in the Huntsing Stock Connect China 80 index. So I would say the short answer is because Alibaba itself is not eligible for the Stock Connect scheme because it is an ADR listed in the US. And that being said, in fact, the index exclusion of ADRs actually helps to reduce exposure to the foreign regulatory risk and helps, I would say, helps it be able to by reducing foreign regulatory risk. So there's further reduction in exposure to the listing from the US exchanges. So actually it could be beneficial for the ETF and the index. Okay. Okay, there's a question about the overlap between the Huntsing Tech ETF and our China Leaders ETF. So as of 28th February, so we see there are 6 overlap stocks between our China Leaders ETF and our Huntsing Tech ETF. They are basically Tencent, Meituan, Xiaomi, JD Health, Alibaba Health, and JD.com. And in terms of the aggregate weights they have, this is roughly around 13.4% in the China Leaders ETF, and also around 36% in the Huntsing Tech ETF, respectively, we see. And in terms of 2 other overlap constituents, we see after the balancing that happened during earlier this month, so 2 new overlap constituents have been also what we noticed. One is Kuaishou, and the other one is Hire a Smart Home, which are the 2 new overlap constituents between the China Leaders ETF and the Huntsing Tech ETF. Okay. Okay, there's a question on whether the management fee is included as part of the total expense ratio. So yes, the management fee is included as part of the total expense ratio. Total expense ratio is roughly 62 basis points, and it will be capped at 62 basis points from the first 2 years of the inception of the ETF. Okay. There's a question on whether the ETF is open to non-Singaporeans. So basically, if you have a broker account, you will be able to subscribe, okay, basically buy or sell the ETF units on your relevant broker's account. Okay. Okay, there's a question of what currencies can I trade the ETF in. You can trade the currencies in Sing dollar using our Sing dollar counter, which is Y, and also renminbi using our renminbi counter, which is YYR. Okay. Okay, I also see a question on how can China still achieve its 5.5% economic growth target. So, I mean, in terms of this broad question, I would say China recently concluded its 2022 National People's Congress. And in its final press conference, as Chinese Premier Li Keqiang explained that China will increase its fiscal expenditure by transferring untapped profits from state-owned financial institutions. So this will help to increase additional government expenditure by roughly 2 trillion yuan. And although the recent Ukraine crisis has added I would say, additional or extra uncertainty into the global economy, we expect that global supply chain will improve further as a result of the reduced and diminished impact of COVID-19. So as such, the strong support from external demand is likely to normalize this year. And so the key will be on whether China will be able to support its growth target. Largely will depend on actually its domestic demand, such as infrastructure investment, property activity, and private consumption. We expect infrastructure investment to lead the recovery in the first half of 2022. But nonetheless, it also requires property activity to stabilize around the mid of 2022 in order to support this growth momentum. And in fact, if private consumption is able to catch up in the second half of 2022, it will support China's position to achieve its 5.5% economic growth target. So in order to summarize, the ideal recovery path will be a strong infrastructure investment in the first half of 2022, followed by a stable housing market in the middle of 2022, and the recovery of private consumption in the second half of this year. Okay. Okay, I see a question about, okay, this is an interesting question. I see a question about how does the China Leaders ETF differ or is different from other Singapore-listed China-focused ETFs that track the MSCI China Index. So currently, there's an ETF that tracks the MSCI China Index within Singapore, and it's called the Xtrackers MSCI China UCITS ETF. And in terms of index construct, the MSCI China Index covers large and mid-cap companies, while the Huntsing Stock Connect China 80 Index, which is what our China Leaders ETF tracks, only covers large cap companies. So in fact, if we conduct, I mean, based on a comparison or a detailed comparison we previously did, 101 China Leaders ETF constituents are inside the Xtrackers MSCI China ETF, which has 750 constituents, and they take up roughly 93% of the weight of the China Leaders ETF. And on the flip side, 101 MSCI of the Xtrackers MSCI China UCITS ETF are inside the China Leaders ETF. So, and they take up roughly 43.5% of the weight of the Xtrackers MSCI China UCITS ETF. So because of that, in fact, the one inference or finding we could find is that the remaining China Leader ETF constituents that are not inside the Xtrackers MSCI China UCITS ETF constituents take up roughly around 6% weight within the China Leaders ETF. And in fact, these are the constituents that help to contribute to some of the resilient performance for our recent resilient performance of our China Leaders ETF. Among these constituents, I mean, we noticed that Meiji Group occupies the highest weightage at around 1.9% and is from the household goods and electronics sector. So in terms of overall, another difference is in terms of the MSCI China Index, it includes constituents that are China A shares, H shares, B shares, red chips, P chips, and various foreign listings. But our index, which is the Huntsing Stock Connect China 80 Index, only covers China A shares and H shares. Okay.
Sorry, Xun Xiang, just to let you know, this is, we just got time for one final question if you'd like to take it.
Okay. I noticed that most of the questions have been addressed. So, from my end, I want to take this last opportunity to highlight that we're again positive on the long-term structural growth story of China. And the Lion-OCBC Securities China Leaders ETF can instantly offer diversified exposure to 80 China market giants. And with just $2 investors will be able to participate in China's growth story by accessing the ETF by logging on to the broker's portal, by searching YYY for the $, counter and YYR for the renminbi counter. So I can hand over the time back to Tommy and yourself.
So Tommy, I'd like to give you a minute to wrap up also if you have any closing statements to make.
Sure. Actually, I do see quite a number of questions. I think there's quite a lot of concern regarding the maybe US-China relationship kind of things and the ADRs, or whether China can survive independently without the US. So I think basically the concerns are quite fundamentally quite similar. So it's basically, frankly speaking, I don't really think China cannot survive without the US. But of course, it's whether it can survive well. That's the key question, right? So I don't think they can survive very well at the moment. So, but as I mentioned, I think the Chinese economy is deeply integrated with the global economy. So it's make China very different from the country like Russia. So I think in the longer run, I still believe, globalization should be the thing. It's good for China as well as for the rest of the world. So I think for China, definitely they will still pursue the path of the globalization. Frankly speaking, China is the key major beneficiary from the globalization. That's why it's in China's incentive to do that. So then, of course, they need to compromise in certain things. I think ADR is one of the things. Just now, I think today, actually, the China security regulator, CSRC, just had one meeting with all the reps from the ADRs. So I think it's interesting. So I think they will try to work on to soften the overall tone, I would say. So I think therefore, I would say we can watch out for those developments, but don't be overly pessimistic. So I think just in the near term, if you want to invest in China, I think two things worth highlighting or worth watching out for. Number one is the COVID situation in China, right? So I think whether China is able to contain this round of the outbreak within a short time frame, I think that's the first test we need to see. The number two, of course, is regarding the spillover from this Ukraine crisis. So as I mentioned, I think in the longer run, I still believe China will try to work on to promote the globalization. I think that's the tone will not be changed by the China side. I think from that perspective, just be patient, but I think stay constructive on China for now. Yeah, I think that's all from me. Thanks.
Yeah, I've got relatives in China and I've got quite a large exposure to China in my portfolio. So, for everyone over there's sake, I really hope that all this passes over really soon and they have a smooth recovery. Thank you again to Tommy and Xun Xiang from OCBC. We have come to the end of today's program, folks, but please make sure you join us next Saturday on April 2nd, because we'll be talking about DLCs, S-REITs, investing methodologies, behavioral science, whether we should be going risk on or risk off, and we will talk even more about China and Hong Kong. Have a great day ahead. We'll see you in 6 days' time. Don't fret if you missed out on any sessions. They will be made available in the recorded sessions tab on this same website next week. And also don't forget to check out the exhibition hall before you go. Thanks again for joining us and see you again at 9 a.m. next Saturday. Bye, everyone.